In this video, I would like to discuss how you could invest globally, you know, taking opportunities, seizing opportunities across the world, how you could adopt global investing. Global investing involves identifying opportunities outside your country or your home geography. So it involves diversifying your investment portfolio by including assets from markets around the world. This approach allows investors to tap into opportunities across different countries and regions and potentially enhancing returns and spreading risk. Here's a breakdown of the key concepts involved in global investing, the benefits, and of course the challenges of being a global investor. So under key concepts of global investing, you have number one, diversification. Diversification. So one of the primary reasons for global investing is to diversify across different economies. By investing in multiple countries, our investors can reduce the risk associated with being too heavily invested in a single country or in one's own country, or in one's own economy. Number two is access to emerging markets. Access to emerging markets. Global investing provides exposure to emerging markets, which can offer high growth potential. Countries like China, India, Brazil, have been growing, they've been like growth leaders in recent years. And investing in these markets can offer opportunities not available in more developed economies. Number three is currency risk. Currency risk. When investing globally, currency fluctuations can impact your returns. For example, if you invest in European stocks and the euro strengthens against your home currency, your return in your local currency could increase. Conversely, a weaker foreign currency could reduce your returns. It's a matter of the performance of your own currency against the currency you are investing, the currency of the company you are investing in. Number five is political and economic risk. Political and economic risk. So global investing involves navigating different political environments, regulations, and economic conditions. And even events like Brexit, that happened, or changes in trade policies can significantly impact international investment. It all happened when Britain exited the European Union. That's a case in point. Number five is global funds and ETFs, global funds and exchange-traded funds. So many investors use global mutual funds or exchange-traded funds to gain exposure to international markets. These funds often spread investment across various regions and sectors, making it easier for individual investors to participate in global markets. You want to invest globally, you buy these funds or ETF that spread, your investment across many countries. Number six is emerging versus developed markets. Emerging versus developed markets. Global investing often involves a mix of developed markets like the US, Europe, and Japan. These are examples of developed markets and emerging markets. So developed markets tend to offer stability and lower risk, while emerging markets offer higher potential returns, but at a considerably greater risk and volatility. So we want to look at the benefit of global investing. the benefits, the advantages of global investing. Number one is enhance diversification. By spreading investment across different regions, global investing reduces the risk of being overly exposed to a given country or a given economy, to any one country or economy. Number two is access to growth opportunities. Investing in fast-growing regions or sectors outside your home market can lead to higher returns. Of course, other markets, other economies, could perform better than yours. As you invest in them, you have a higher return compared to if you are essentially investing only in your own country. Number three is hedge against down domestic risk. Hedge against domestic risk. If your home country faces economic challenges, global investment can help you to protect your portfolio. If your country is facing economic difficulty or turmoil, then you can diversify. You can hedge your risk by investing in other countries. Let's look at the challenges of global investing. We've considered the benefits. We want to look at the challenges now. Number one is a currency fluctuation. Currency fluctuations. And as mentioned earlier, changes in exchange rates can impact your returns tremendously. Number two is political and regulatory risk. Different countries have different regulations. They have different tax policies, and levels of political stability, which can affect your investments. So the political risk is there, and other factors you could equally consider are there. Different regulations, different tax policies could weigh in, could weigh on your returns. Number three is market access. Market access. Not all global markets are easily accessible to individual investors, and some may have higher transaction costs or limited liquidity. Some markets are very difficult to access. Some of them have liquidity problems, and other ones, have higher transaction costs. So we look at the strategy you could consider, strategic consideration here. Number one is a geographical allocation. When it comes to the strategy you could adopt, you can adopt, geographical allocation. You may decide, how much of your portfolio to allocate to different regions, such as North America, Europe, Asia, or emerging markets, including African countries like mine, So number two is sector allocation. Consider how global trends might impact different sectors, such as technology, healthcare, or energy, and you'll allocate accordingly. So when it comes to the strategy, will involve a very good strategy and important, a very common strategy is the adoption of sector allocation. Number three is monitoring global events. So stay informed about global economic trends, political developments, and market news that could affect your investment returns. So you don't just invest and go to sleep. You make sure that you are at alert concerning global events. Probably the company you invested in may be at the brink of war, political conflict or whatsoever. So you have to be very, very, you need to be aware on time so as to liquidate your investment and safely bring your funds home. You need to stay alert and monitor global events. So this strategy actually, how about what is suitability? Who is it for? That's a very important question. So globally investing is suitable for investors who want to diversify their portfolios beyond their home economy and are comfortable with the additional risk of investing in foreign markets. I've just highlighted the risk. If you are comfortable with those risks and complexities, you can go ahead and then invest globally. Templeton. Sir Templeton was a very popular global investor in his time. It's ideal for those looking to to capitalize on growth opportunities worldwide and reduce the impacts of the, the impact their domestic economy could have on their portfolios, and to avoid any market downturn their domestic country could be facing or could be exposed to. So these are what you need to consider if you really want to adopt this particular strategy.